Question 1. Regulatory review indicates that a client wishes to donate a significant piece of art to a private foundation they have established, seeking to claim a substantial tax deduction. The client believes the value of the art is high and wants to proceed with the donation promptly. What is the most prudent course of action for the advisor to recommend to ensure the client maximizes their tax benefit while remaining compliant with all applicable tax laws and regulations? Option A. Advise the client to obtain a qualified appraisal for the artwork and consult with a tax professional specializing in charitable giving and private foundations to determine the deductibility and proper substantiation of the donation. Option B. Suggest the client claim a deduction based on their personal estimation of the artwork's value, as this reflects their intent to give generously. Option C. Advise the client that any donation to a private foundation is fully tax deductible and to proceed with the donation, as the foundation will handle all tax reporting. Option D. Recommend the client donate the artwork directly to a public charity instead, as this generally offers simpler tax deduction rules. The correct answer is A. Advise the client to obtain a qualified appraisal for the artwork and consult with a tax professional specializing in charitable giving and private foundations to determine the deductibility and proper substantiation of the donation. Explanation. This scenario is professionally challenging because it requires the advisor to navigate the complex interplay between tax law and charitable giving regulations, specifically concerning the deductibility of donations made through a private foundation. The advisor must ensure that the client's actions align with the legal requirements for charitable contributions to be tax deductible, thereby maximizing the client's tax benefit while adhering to all relevant legislation. A key aspect is understanding the limitations and rules surrounding contributions to private foundations, which often have stricter requirements than direct donations to public charities. The correct approach involves advising the client to consult with a qualified tax professional specializing in charitable giving and private foundations. This is crucial because tax laws governing charitable deductions, particularly for contributions to private foundations, are intricate and subject to specific IRS regulations, assuming U.S. jurisdiction for the CPRIA exam. These regulations dictate the types of contributions that are deductible, the valuation methods for non-cash donations, and the substantiation requirements. A specialist can accurately assess the deductibility of the specific asset being considered for donation, ensure compliance with reporting obligations, and advise on any potential pitfalls or limitations that might affect the client's tax position. This aligns with the advisor's ethical duty to provide competent advice and to act in the client's best interest by ensuring they receive the full tax benefits legally available. An incorrect approach would be to advise the client that any donation to a private foundation is automatically tax deductible without further qualification. This fails to acknowledge the specific rules and limitations that apply to private foundations, such as those related to self-dealing, excess business holdings, and taxable expenditures, which can impact deductibility. Another incorrect approach would be to suggest that the client can claim a deduction based on their own valuation of the asset without considering IRS guidelines for appraisal and substantiation. This disregards the stringent requirements for documenting non-cash charitable contributions, particularly for significant assets, and could lead to disallowed deductions and penalties. Finally, advising the client to proceed with the donation without any tax consultation, assuming the private foundation will handle all tax implications, is also incorrect. While the foundation has reporting responsibilities, the donor is ultimately responsible for ensuring their own tax deduction is valid and properly supported. A professional decision-making process for similar situations should begin with identifying the core legal and tax implications of the client's proposed action. This involves recognizing when specialized knowledge is required, such as in complex tax matters or specific areas of law like charitable giving and private foundations. The advisor should then assess their own expertise and, if necessary, recommend consultation with a qualified specialist. Throughout the process, maintaining clear communication with the client about the complexities involved and the recommended steps is paramount. The advisor must prioritize compliance with all applicable regulations and ethical standards, ensuring that the client's interests are protected and that they receive accurate and actionable advice. Question 2. The control framework reveals that a private client, seeking to minimize immediate insurance premiums, has requested a risk management strategy that involves underinsuring certain high-value assets. The client explicitly states that they are aware of the potential shortfall but wish to proceed on this basis to reduce upfront costs. As a chartered private risk and insurance advisor, CPRIA, what is the most ethically and professionally responsible course of action? Option A. Inform the client that their request is not feasible and refuse to provide any further advice on this matter, suggesting they seek advice elsewhere. Option B. Agree to the client's request to underinsure the assets, as their explicit instruction overrides the advisor's professional judgment in this instance. Option C. Advise the client on the specific risks and potential consequences of underinsuring their assets. Present alternative risk mitigation strategies that align with regulatory requirements and their long-term financial well-being, and document the discussion and the client's final decision. Option D. Proceed with the client's request to underinsure the assets, but include a disclaimer in the documentation that the advisor is not liable for any future losses due to this decision. The correct answer is C. Advise the client on the specific risks and potential consequences of underinsuring their assets. Present alternative risk mitigation strategies that align with regulatory requirements and their long-term financial well-being, and document the discussion and the client's final decision. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial interests of a client with the long-term ethical obligations of a risk advisor. The advisor must navigate potential conflicts of interest and ensure that their recommendations are not unduly influenced by personal gain or pressure from the client, adhering strictly to the principles of professional conduct expected of a chartered private risk and insurance advisor, CPRIA. The core of the challenge lies in maintaining objectivity and integrity when faced with a situation where a client's desired outcome might compromise sound risk management principles or regulatory compliance. The correct approach involves prioritizing the client's ultimate best interest, which includes their long-term financial security and regulatory compliance, over short-term gains or the avoidance of difficult conversations. This means providing advice that is both ethically sound and practically beneficial, even if it means challenging the client's initial proposal. This aligns with the CPRIA commitment to professional integrity and client welfare, as outlined in the professional conduct rules, which mandate that advisors act with honesty, diligence, and in the best interests of their clients. Avoiding conflicts of interest and ensuring advice is objective and unbiased. An incorrect approach that prioritizes the client's immediate, potentially ill-advised, request without further scrutiny fails to uphold the advisor's fiduciary duty. This could lead to regulatory breaches if the recommended course of action exposes the client to unacceptable risks or non-compliance with relevant insurance or financial regulations. Another incorrect approach that involves agreeing to the client's request while subtly downplaying the associated risks or failing to fully disclose them constitutes a breach of transparency and honesty. This misleads the client and can result in significant future financial and reputational damage, violating the ethical imperative to provide full and accurate information. A further incorrect approach that involves deferring the decision to the client without providing robust, objective advice, even when the client's request is demonstrably flawed, abdicates professional responsibility, and fails to act in the client's best interest. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's objectives and the associated risks. This involves critically evaluating the client's proposals against established risk management principles, regulatory requirements, and ethical standards. When a discrepancy arises, the advisor should clearly articulate the risks and potential consequences of the client's preferred course of action, offering alternative, ethically compliant, and risk-mitigating solutions. Open and honest communication, coupled with a commitment to professional integrity, is paramount in guiding the client towards a decision that serves their long-term interests. Question 3. The monitoring system demonstrates that a private client owns a collection of high-value vehicles, including a 1965 Ferrari 275 GTB and a 2023 McLaren Artura. The client is seeking insurance coverage for these vehicles. Which of the following approaches best addresses the unique insurance needs for these types of assets within the regulatory framework governing private client insurance advice? Option A. Suggest a basic liability-only policy, as the client's primary concern appears to be protecting against third-party claims, and the vehicles are primarily for collection purposes. Option B. Recommend a standard comprehensive auto insurance policy with a significantly increased stated value for each vehicle to reflect their market worth. Option C. Propose a standard collision and comprehensive policy, assuming that the insurer's standard valuation methods will adequately cover the potential loss of these exotic and classic automobiles. Option D. Advise the client to obtain independent appraisals for each vehicle, and then secure agreed value policies that reflect these appraised values, ensuring coverage for specialized risks and agreed-upon valuation in case of a total loss. The correct answer is B. Recommend a standard comprehensive auto insurance policy with a significantly increased stated value for each vehicle to reflect their market worth. Explanation: this scenario is professionally challenging because advising on high-value vehicle insurance requires a nuanced understanding of both the client's specific needs and the regulatory landscape governing private client insurance. The inherent value and unique characteristics of exotic and classic cars necessitate coverage beyond standard auto policies, demanding careful consideration of valuation methods, agreed value clauses, and specialized underwriting. Failure to accurately assess these factors can lead to underinsurance, disputes, and regulatory noncompliance. The correct approach involves a thorough needs analysis that prioritizes understanding the client's specific risk profile and the unique characteristics of their high-value vehicles. This includes discussing agreed value policies, which are crucial for classic and exotic cars, to ensure the insurer and insured agree on the vehicle's value prior to a loss, thereby avoiding disputes over market value depreciation. It also involves exploring specialized endorsements for items like custom parts, accessories, and potentially even coverage for the vehicle's use in curated events or shows, if applicable to the client's lifestyle. This approach aligns with the regulatory duty to act in the client's best interest and to provide advice that is suitable and appropriate, as mandated by the principles of good conduct and consumer protection within the relevant regulatory framework for the Chartered Private Risk and Insurance Advisor (CPRIA) exam. An incorrect approach would be to simply recommend a standard comprehensive policy with a higher coverage limit. This fails to address the specific valuation challenges of high-value vehicles, which often do not depreciate linearly like standard vehicles and may appreciate in value. This could lead to the client being underinsured if a total loss occurs, as the payout would be based on a depreciated market value rather than the agreed-upon value. This also neglects the specialized underwriting and risk assessment required for such vehicles, potentially leading to policy exclusions or inadequate coverage for unique risks associated with their storage, maintenance, or use. Another incorrect approach would be to focus solely on the lowest premium without adequately discussing the scope of coverage and the implications of different valuation methods. This prioritizes cost over adequate protection, which violates the duty to ensure the client understands the coverage they are purchasing and that it meets their needs. It also risks misrepresenting the value of the coverage provided, potentially leading to client dissatisfaction and regulatory scrutiny for failing to provide suitable advice. A third incorrect approach would be to assume that a standard policy can be easily adapted by simply increasing the stated value. This overlooks the fact that insurers often have specific underwriting guidelines and requirements for high-value vehicles, including stipulations on storage, security, and usage. Without adhering to these, the policy may be voidable or the insurer may deny a claim, leaving the client exposed. This demonstrates a lack of due diligence and an inadequate understanding of the specialized market for private client auto insurance. The professional decision-making process for similar situations should begin with a comprehensive client discovery phase to understand their assets, lifestyle, and risk tolerance. This should be followed by a detailed discussion of the specific risks associated with their high-value vehicles, including their unique valuation, storage, and usage patterns. The advisor must then research and present suitable insurance solution, clearly explaining the benefits and limitations of each, with a particular emphasis on agreed value clauses and specialized endorsements. Transparency regarding policy terms, conditions, and exclusions is paramount, ensuring the client makes an informed decision based on their specific needs and the regulatory requirements for providing suitable advice. Question 4. Benchmark analysis indicates that clients seeking insurance for valuable jewelry items often underestimate the specific coverage requirements beyond standard homeowners policies. A chartered private risk and insurance advisor, CPRIA, is consulting with a client who possesses a collection of antique diamond necklaces and a rare sapphire engagement ring, collectively valued at over $150,000. The client's current homeowner's policy has a jewelry sublimit of $5,000. Which of the following approaches best aligns with the advisor's professional obligations and regulatory framework for ensuring adequate and compliant coverage for these valuable items? Option A. Suggest the client simply declare a total value of $150,000 for their jewelry on their homeowner's policy, as most insurers will accept this declaration for claims purposes. Option B. Advise the client to increase the jewelry sublimit on their existing homeowner's policy to $150,000, assuming the insurer will approve it without further documentation. Option C. Recommend the client obtain professional appraisals for each item and then secure a separate scheduled personal property endorsement or a specialized jewelry policy to cover the full appraised value. Option D. Advise the client that standard homeowners policies are generally sufficient for most jewelry and that the $5,000 sublimit is usually adequate for typical losses. The correct answer is B. Advise the client to increase the jewelry sublimit on their existing homeowner's policy to $150,000, assuming the insurer will approve it without further documentation. Explanation. This scenario is professionally challenging because it requires the advisor to balance the client's desire for comprehensive coverage with the insurer's underwriting requirements and the regulatory obligations to provide accurate and suitable advice. The advisor must navigate the complexities of insuring high-value, unique items like jewelry, which often fall outside standard policy limits and require specialized appraisal and underwriting. The advisor's duty is to ensure the client understands the limitations and requirements of jewelry insurance, thereby preventing potential underinsurance and subsequent claims disputes, while also adhering to the principles of good faith and fair dealing expected by regulators. The correct approach involves a thorough understanding of the client's specific jewelry items, including their appraised value, provenance, and any unique characteristics. This necessitates advising the client to obtain professional appraisals from qualified gemologists or appraisers, as stipulated by most insurers for high-value items. The advisor must then ensure that the policy purchased accurately reflects these appraised values and includes appropriate endorsements or riders for scheduled personal property. This aligns with regulatory requirements to provide advice that is suitable for the client's needs and circumstances, ensuring transparency regarding coverage limits and exclusions. It also upholds the principle of utmost good faith by accurately representing the risk to the insurer. An incorrect approach would be to assume that standard homeowners or renters insurance policies offer sufficient coverage for valuable jewelry. These policies typically have sublimits for specific categories of personal property, including jewelry, which are often significantly lower than the actual value of the items. Relying on these sublimits without advising the client to schedule the jewelry separately would lead to underinsurance, a failure to meet the client's needs, and a potential breach of the advisor's duty of care. Another incorrect approach is to advise the client to simply declare a higher value without supporting documentation. Insurers require proof of value, typically through recent appraisals, to underwrite such risks and set premiums appropriately. Without this, the declared value may be rejected by the insurer, or the policy may be voided if a claim arises and the insurer discovers the discrepancy. This misrepresentation, even if unintentional, can lead to regulatory scrutiny and reputational damage. Finally, advising the client to forego specific jewelry insurance in favor of a general policy, without clearly explaining the limitations and potential financial consequences, is also professionally unsound. The advisor has a responsibility to educate the client about the risks associated with underinsurance and the benefits of specialized coverage for valuable assets. The professional decision-making process for similar situations should involve a structured approach. 1. Client needs assessment. Understand the client's assets, their value, and their risk tolerance. 2. Regulatory compliance check. Identify all relevant regulations and guidelines pertaining to the specific insurance products and client circumstances. 3. Product suitability analysis. Evaluate available insurance products against client needs and regulatory requirements. 4. Transparency and disclosure. Clearly communicate policy terms, conditions, limitations, and exclusions to the client. 5. Documentation and record keeping. Maintain thorough records of client interactions, advice provided, and policy selections. Question 5. Research into a new, complex private client portfolio reveals a need for comprehensive risk identification. Which method would best ensure all potential risks are uncovered, considering the unique nature of private wealth and the advisor's professional obligations? Option A. Exclusive reliance on historical data analysis from previously managed, but not identical, private client portfolios. Option B. A systematic review of the client's existing structures, assets, liabilities, and objectives, supplemented by industry-specific risk databases and expert consultations. Option C. Application of a generic predefined checklist designed for standard retail investment portfolios. Option D. Conducting informal brainstorming sessions with the client without any structured framework or external data input. The correct answer is B. A systematic review of the client's existing structures, assets, liabilities, and objectives, supplemented by industry-specific risk databases and expert consultations. Explanation. This scenario is professionally challenging because the advisor must select the most effective risk identification method for a new, complex private client portfolio, balancing thoroughness with efficiency. The advisor's judgment is critical in ensuring that all significant potential risks are uncovered without overwhelming the client or wasting resources. The correct approach involves a systematic and comprehensive review of the client's existing financial structures, assets, liabilities, and stated objectives, augmented by industry-specific risk databases and expert consultations. This method is correct because it directly addresses the core requirement of risk identification by leveraging multiple, validated sources of information. It aligns with the professional duty of care expected of a chartered private risk and insurance advisor, which mandates a thorough understanding of the client's unique circumstances and potential exposures. Regulatory frameworks for financial advisors typically emphasize a proactive and diligent approach to risk assessment, ensuring that advice provided is based on a complete and accurate understanding of the client's risk profile. This comprehensive method ensures that both obvious and subtle risks are identified, fulfilling the advisor's obligation to act in the client's best interest. An incorrect approach would be to rely solely on a generic checklist without tailoring it to the specific nuances of the private client's portfolio. This is professionally unacceptable because generic checklists often fail to capture the unique, complex, or emerging risks associated with sophisticated private wealth. It represents a failure to exercise due diligence and a potential breach of the duty of care, as it may lead to overlooked critical risks. Another incorrect approach would be to exclusively use historical data analysis from similar, but not identical, client portfolios. While historical data is valuable, it is insufficient on its own for a new, complex portfolio. This is professionally unacceptable because it assumes past risk patterns will perfectly predict future risks for this specific client, ignoring potential unique exposures or changes in the economic or regulatory landscape. It demonstrates a lack of bespoke analysis and a potential failure to identify novel or specific risks. A further incorrect approach would be to solely conduct brainstorming sessions with the client without any structured methodology or external data. This is professionally unacceptable because while client input is vital, unguided brainstorming can be subjective, prone to bias, and may not cover all technical or regulatory risk areas. It lacks the systematic rigor required for comprehensive risk identification and may miss risks that the client is unaware of or does not perceive as significant. The professional decision-making process for similar situations should involve a phased approach. First, understanding the client's specific context, objectives, and existing portfolio through detailed information gathering. Second, employing a combination of structured methods like tailored checklists and expert knowledge. Third, leveraging relevant historical data and industry benchmarks as supplementary tools. Finally, engaging the client in a collaborative discussion to validate identified risks and gather their perspectives, ensuring a holistic and robust risk identification process. Question 6. To address the challenge of advising a high net worth individual, HNWI, on property and casualty insurance for their diverse and high-value asset portfolio, which approach best aligns with regulatory requirements and professional ethical standards? Option A. Conduct a detailed needs analysis and risk assessment of each asset, obtain accurate and current valuations, and then present tailored policy options that clearly outline coverage, exclusions, and limitations, ensuring transparency with both the client and the insurer. Option B. Prioritize securing the broadest possible coverage limits for all assets, assuming that higher limits inherently provide superior protection, and then seek insurers willing to underwrite these limits. Option C. Focus on obtaining coverage for the most visible or frequently discussed assets, such as primary residences and vehicles, and defer detailed assessment of less prominent assets like art collections or jewelry until a claim arises. Option D. Rely on the client's own estimations of asset values and coverage needs, focusing on the most cost-effective options available, and assume that standard policy wordings will suffice for most HNWI assets. The correct answer is B. Prioritize securing the broadest possible coverage limits for all assets, assuming that higher limits inherently provide superior protection, and then seek insurers willing to underwrite these limits. Explanation: this scenario is professionally challenging because it requires the advisor to balance the client's desire for comprehensive coverage with the insurer's underwriting guidelines and the advisor's fiduciary duty. High net worth individuals, HNWI, often possess unique and high-value assets, such as fine art, classic cars, and multiple residences, which present complex risk profiles. The advisor must navigate potential coverage gaps, ensure accurate valuation of assets, and maintain compliance with regulatory requirements for advising on such specialized insurance products. The core challenge lies in providing advice that is both tailored to the client's specific needs and adheres to the principles of sound insurance practice and regulatory mandates. The correct approach involves a thorough needs analysis, accurate risk assessment, and transparent communication with both the client and the insurer. This includes understanding the specific policy terms and conditions, identifying potential exclusions, and ensuring that the coverage limits adequately reflect the value of the HNWI assets. Regulatory justification stems from the advisor's obligation to act in the client's best interest, which includes providing advice that is suitable and compliant with all applicable insurance laws and regulations. This often involves adhering to principles of utmost good faith and ensuring that all material facts are disclosed. An incorrect approach that focuses solely on securing the highest possible coverage limits without a proper assessment of the underlying risks or the insurer's appetite for those risks would be professionally unacceptable. This could lead to policy rejection, increased premiums due to inadequate underwriting, or even claims disputes if the coverage is not aligned with the actual risk exposure. Ethically, this fails to uphold the duty of care and suitability. Another incorrect approach that prioritizes speed and convenience over accuracy, such as relying on outdated valuations or making assumptions about asset values, would also be problematic. This violates the principle of accurate representation of risk to the insurer and could result in underinsurance or overinsurance, both of which are detrimental to the client. Regulatory failure here would involve misrepresentation or omission of material facts. A third incorrect approach that involves recommending policies with significant coverage gaps or exclusions that are not clearly communicated to the client is also unacceptable. This breaches the advisor's duty to ensure the client understands the scope of their protection and the limitations of their policy. It can lead to significant financial loss for the client in the event of a claim and constitutes a failure in professional diligence and transparency. The professional decision-making process should involve a structured approach. 1. Understand the client's assets and liabilities comprehensively. 2. Conduct a detailed risk assessment for each asset. 3. Research and select appropriate insurance products and insurers with expertise in HNWI risks. 4. Obtain accurate valuations for all insured items. 5. Clearly explain policy terms, conditions, exclusions, and limitations to the client. 6. Ensure all disclosures to the insurer are accurate and complete. 7. Regularly review the client's insurance program to account for changes in their circumstances or asset values. Question 7. Analysis of a proposed investment strategy for a high net worth client that promises exceptionally high returns, but carries significant volatility and potential for substantial capital loss, requiring the chartered private risk and insurance advisor to evaluate the most appropriate risk mitigation approach. The advisor has identified that the strategy involves complex derivatives and illiquid assets. Option A. Advise the client to completely avoid the proposed investment strategy due to its inherent volatility and potential for capital loss, irrespective of any potential control mechanisms. Option B. Recommend implementing a comprehensive suite of control measures, including diversification within the strategy's asset classes, setting strict stop-loss orders, and utilizing hedging instruments to cap potential downside exposure, thereby managing residual risk within the client's stated risk tolerance. Option C. Suggest transferring all the risk associated with the strategy to a third party through an insurance product, without a thorough analysis of the product's coverage limitations and cost-effectiveness. Option D. Proceed with recommending the investment strategy based on its high return potential, assuming the client understands and accepts the inherent risks without further detailed risk assessment or control implementation. The correct answer is B. Recommend implementing a comprehensive suite of control measures, including diversification within the strategy's asset classes, setting strict stop-loss orders, and utilizing hedging instruments to cap potential downside exposure, thereby managing residual risk within the client's stated risk tolerance. Explanation. This scenario presents a professionally challenging situation because it requires a private risk and insurance advisor to balance the client's desire for aggressive growth with the fundamental principles of risk management and regulatory compliance. The advisor must critically evaluate the proposed strategy not just for its potential financial upside, but for its adherence to established risk mitigation techniques and the fiduciary duty owed to the client. Careful judgment is required to avoid recommending a course of action that, while potentially lucrative, exposes the client to unacceptable levels of unmanaged risk or violates regulatory expectations for prudent advice. The correct approach involves a thorough assessment of the proposed investment strategy through the lens of established risk mitigation techniques, specifically focusing on control measures. This entails identifying the specific risks inherent in the strategy, evaluating the effectiveness of any proposed controls, and determining if residual risks are within the client's acceptable risk tolerance. Regulatory frameworks for financial advisors, such as those overseen by the Financial Conduct Authority, FCA, in the UK, emphasize the importance of suitability, client understanding, and the provision of advice that is in the client's best interests. Implementing robust control measures, such as diversification, hedging, or the use of specific financial instruments designed to limit downside exposure, directly aligns with these regulatory and ethical obligations. This approach prioritizes the client's long-term financial well-being and adherence to regulatory standards over short-term speculative gains. An incorrect approach would be to recommend the strategy without a detailed risk assessment, focusing solely on the potential for high returns. This failure to implement control measures or adequately assess residual risk would violate the advisor's duty to act in the client's best interests and could contravene FCA principles requiring firms to act with integrity, skill, care, and diligence. Another incorrect approach would be to suggest outright avoidance of the strategy without exploring potential control mechanisms. While avoidance is a valid risk mitigation technique, it may be overly simplistic and fail to consider that with appropriate controls, the strategy might become viable and align with the client's objectives. This could be seen as a failure to provide comprehensive advice. Recommending a transfer of risk without understanding the cost and effectiveness of such a transfer, or without ensuring the client fully comprehends the implications, would also be an ethical and regulatory failure, as it might not be a suitable or cost-effective solution for the client. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the client's objectives and risk tolerance. Second, identify all inherent risks associated with any proposed strategy. Third, evaluate the effectiveness and feasibility of various risk mitigation techniques, avoidance, transfer, and control in addressing these identified risks. Fourth, assess the residual risk after applying mitigation strategies and compare it to the client's tolerance. Fifth, ensure full transparency with the client regarding the risks, rewards, and costs of any recommended strategy. Finally, document the entire process and the rationale for the advice provided, ensuring compliance with all relevant regulatory requirements. Question 8. The investigation demonstrates that a private risk advisor is reviewing a proposed insurance premium for a high-net-worth individual. The insurer has provided a breakdown indicating that the premium is influenced by several factors, including the insured property's location, age, and construction type, as well as the insured's claims history. However, the advisor notes that the insurer's internal documentation also suggests a slight upward adjustment to the premium for clients residing in affluent postcodes, citing a perceived higher propensity for opportunistic theft in such areas, even when controlling for other risk factors. The advisor must determine the most appropriate course of action regarding this pricing element. Option A. Accept the postcode adjustment as a minor factor that contributes to the overall premium, assuming it is a common industry practice for affluent clients. Option B. Recommend that the client consider alternative insurers who may not factor in postcode affluence, without questioning the current insurer's methodology. Option C. Challenge the insurer's inclusion of postcode affluence as a direct pricing factor, advocating for its removal or justification based on demonstrable, non-discriminatory risk data that aligns with regulatory expectations for fair pricing. Option D. Advise the client that the premium is calculated based on the insurer's risk assessment, which includes all factors they deem relevant, and proceed with the policy as quoted. The correct answer is D. Advise the client that the premium is calculated based on the insurer's risk assessment, which includes all factors they deem relevant, and proceed with the policy as quoted. Explanation. This scenario is professionally challenging because it requires an advisor to balance the insurer's need for accurate pricing with the client's perception of fairness and the regulatory imperative to avoid unfair discrimination. The advisor must understand that while risk characteristics are fundamental to premium calculation, certain factors are prohibited from influencing pricing to prevent discriminatory practices. The core of the challenge lies in discerning between legitimate risk factors and those that are legally or ethically impermissible. The correct approach involves a thorough understanding of the regulatory framework governing insurance pricing, specifically the FCA's principles for businesses and Consumer Credit Sourcebook, where applicable, and guidance from the ABI, Association of British Insurers, on fair pricing. This approach prioritizes identifying and utilizing only those risk characteristics that are demonstrably linked to the likelihood or severity of a claim, as permitted by law and industry best practice. It requires the advisor to critically evaluate the insurer's proposed pricing model, ensuring it does not incorporate prohibited factors such as age, unless demonstrably and legally justifiable for specific product types and within regulatory limits, gender, or other protected characteristics, except where explicitly allowed and justified by actuarial data and regulatory approval. The ethical and regulatory justification stems from the FCA's Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which mandate treating customers fairly and providing clear, not misleading information. The advisor must ensure the premium reflects a fair assessment of risk without resorting to discriminatory practices. An incorrect approach that relies solely on the insurer's stated pricing model without independent verification of the underlying risk factors would be professionally unacceptable. This fails to uphold the advisor's duty to act in the client's best interests, FCA Principle 6, and could lead to the client being charged an unfairly high premium based on irrelevant or prohibited factors. Another incorrect approach that attempts to justify premium differences based on factors not directly related to insurance risk, such as the client's perceived ability to pay or their social standing, is ethically and regulatorily flawed. This constitutes unfair discrimination and violates the principle of treating customers fairly. It also breaches FCA Principle 7, by potentially misleading the client about the basis of their premium. A further incorrect approach that involves selectively disclosing only the risk factors that support a higher premium while omitting those that might justify a lower one is a breach of transparency and honesty, violating FCA Principle 7. This misrepresents the pricing structure and undermines client trust. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's needs and risk profile. Gather comprehensive information about the client's circumstances relevant to the insurance being sought. 2. Review insurer's proposal and pricing rationale. Obtain a clear explanation from the insurer regarding how the premium has been calculated, including the specific risk factors used. 3. Regulatory compliance check. Critically assess the identified risk factors against the relevant UK regulatory framework, including FCA rules and any specific industry codes of conduct. Determine if each factor is a permissible basis for premium calculation and if it is applied in a non-discriminatory manner. 4. Ethical considerations. Evaluate whether the pricing, even if technically compliant, is fair and transparent to the client. Consider the spirit of treating customers fairly. 5. Client communication. Clearly explain to the client the basis of the premium, highlighting the risk factors that influence it and ensuring they understand why the premium is set at that level. If concerns arise about fairness or compliance, the advisor must address them proactively. 6. Seek clarification or alternative options. If any doubt exists regarding the appropriateness or legality of a pricing factor, the advisor must seek further clarification from the insurer or explore alternative insurance products or providers. Question 9. During the evaluation of a client's claim following a significant property damage event, the client expresses a strong desire to receive the full sum insured, stating that they paid for the whole policy and therefore deserve the maximum payout, even though their assessment of the actual repair costs is considerably lower than the sum insured. The client is also suggesting including a few minor items that were not damaged in the claim to make up for the inconvenience. Which of the following approaches best aligns with the principles of insurance and regulatory expectations for a chartered private risk and insurance advisor? Option A. Suggest that the client approach other insurers who may have also insured the property and claim the full sum insured from each, without disclosing the existence of other policies. Option B. Advise the client that the payout will be based on the actual documented loss incurred, up to the sum insured, and explain that claiming for undamaged items is not permissible. Option C. Agree with the client's assertion that the full sum insured is payable regardless of the actual loss, as they have paid premiums for the entire policy term. Option D. Recommend that the client claim for the full sum insured, and also include the additional undamaged items to compensate for the inconvenience, as this is a common practice. The correct answer is B. Advise the client that the payout will be based on the actual documented loss incurred, up to the sum insured, and explain that claiming for undamaged items is not permissible. Explanation. This scenario is professionally challenging because it requires the advisor to balance the client's immediate desire for a specific outcome with the fundamental principles of insurance that govern the contract. The advisor must ensure that any advice provided aligns with the regulatory framework and ethical obligations, particularly concerning the principle of indemnity. The correct approach involves advising the client that the payout should reflect the actual loss incurred, not an amount exceeding it. This aligns with the principle of indemnity, which states that insurance is a contract of indemnity, meaning the insured should be restored to the financial position they were in before the loss occurred, no more and no less. This principle is a cornerstone of insurance law and is implicitly or explicitly mandated by the regulatory framework governing insurance advice. Adhering to this principle upholds the integrity of the insurance contract and prevents moral hazard. An incorrect approach would be to advise the client that they are entitled to the full sum insured regardless of the actual loss. This directly violates the principle of indemnity. Ethically, it is misleading and could lead to the client making a fraudulent claim, which is illegal and breaches the duty of utmost good faith owed by both parties to the insurance contract. Another incorrect approach would be to suggest that the client should claim for items that were not damaged or lost. This is dishonest and constitutes fraud, a severe breach of the duty of utmost good faith and potentially illegal. It also undermines the principle of proximate cause, as the claim would not be for a loss directly and solely caused by the insured peril. A further incorrect approach would be to advise the client to seek compensation from multiple insurers for the same loss without full disclosure. This contravenes the principle of contribution, which dictates that if a loss is covered by more than one policy, the insurers will contribute to the payout proportionally, and the insured cannot recover more than the actual loss from all sources combined. Failing to disclose multiple policies is a breach of utmost good faith and can lead to claims being invalidated. Professionals should approach such situations by first identifying the core insurance principles at play. They must then assess the client's request against these principles and the relevant regulatory requirements. If a client's request conflicts with these principles, the advisor's duty is to educate the client on the correct application of insurance law and ethics, guiding them towards a compliant and fair resolution, even if it means managing the client's expectations about the potential payout. Question 10. Strategic planning requires a thorough understanding of a client's evolving circumstances and objectives when advising on estate planning matters. Mr. Arthur Pendleton, a long-standing client, has recently expressed a desire to update his estate plan. He has an existing revocable living trust established 5 years ago, which holds a significant portion of his assets, and a simple will that directs any remaining assets not covered by the trust to his children. Mr. Pendleton now wishes to ensure that his grandchildren receive a portion of his assets directly, with specific provisions for their education, and is concerned about potential future creditors of his children impacting these inheritances. He has also mentioned a desire to minimize any inheritance tax liability. Which of the following approaches best addresses Mr. Pendleton's current estate planning needs and aligns with professional advisory standards? Option A. Conduct a comprehensive review of Mr. Pendleton's existing trust and will, discuss his updated objectives regarding his grandchildren's education and asset protection from his children's creditors, and then propose tailored amendments or new documents to achieve these goals while considering tax implications. Option B. Recommend that Mr. Pendleton postpone any significant estate planning changes until his health deteriorates further, as this will provide a clearer picture of his final wishes and potential tax liabilities. Option C. Advise Mr. Pendleton to create a new will that specifically bequeaths assets to his grandchildren, disregarding the existing trust as it is revocable and can be easily changed later. Option D. Focus solely on implementing strategies to minimize inheritance tax, suggesting the transfer of assets to his children immediately to reduce the taxable estate, even if it means deviating from his stated desire for direct inheritance for his grandchildren. The correct answer is A. Conduct a comprehensive review of Mr. Pendleton's existing trust and will, discuss his updated objectives regarding his grandchildren's education and asset protection from his children's creditors, and then propose tailored amendments or new documents to achieve these goals while considering tax implications. Explanation: this scenario is professionally challenging because it requires the advisor to navigate the complex interplay of a client's evolving personal circumstances with the legal and ethical obligations surrounding estate planning advice. The advisor must balance the client's immediate desires with the long-term implications of their decisions, ensuring that the advice provided is both legally sound and ethically responsible, adhering strictly to the regulatory framework governing the Chartered Private Risk and Insurance Advisor (CPRIA) designation. The correct approach involves a comprehensive review of the client's existing estate plan, a thorough understanding of their current financial situation and family dynamics, and a detailed discussion of their updated objectives. This approach is right because it aligns with the CPRIA ethical code and regulatory requirements, which mandate that advisors act in the client's best interest, provide advice based on accurate and up-to-date information, and ensure clients understand the implications of their estate planning choices. Specifically, it addresses the fiduciary duty to act with prudence and diligence, and the regulatory expectation to offer advice that is suitable and tailored to the client's unique circumstances. This ensures that any proposed changes to the will or trust documents are legally effective and achieve the client's intended outcomes, avoiding potential disputes or unintended consequences. An incorrect approach that focuses solely on drafting a new will without assessing the existing trust structure fails, because it ignores the potential for conflicts or inefficiencies between the two documents. This could lead to a fragmented estate plan, where the will and trust operate at cross purposes, potentially undermining the client's overall objectives and creating legal complexities. This violates the duty to provide comprehensive and integrated advice. Another incorrect approach that prioritizes immediate tax savings over the client's stated desire for asset protection for their grandchildren is ethically flawed. While tax efficiency is a component of estate planning, it should not supersede the client's primary goals and wishes. This approach demonstrates a failure to prioritize the client's stated intentions and could result in an estate plan that does not reflect their true values or needs, potentially leading to dissatisfaction and legal challenges. This breaches the ethical obligation to respect client autonomy and to act in accordance with their expressed wishes. A further incorrect approach that suggests delaying any changes until after the client's health significantly deteriorates is professionally negligent. Estate planning is a proactive process. Waiting until a client's capacity is diminished can lead to decisions being made under duress or without full understanding, and may prevent the client from implementing their wishes effectively. This contravenes the principle of timely and appropriate advice and could expose the advisor to liability for failing to act diligently. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the client's current situation and existing estate plan. Second, engage in open and detailed communication to ascertain their updated goals, concerns, and priorities. Third, analyze the legal and regulatory landscape relevant to their circumstances. Fourth, develop and present a range of suitable options, clearly explaining the benefits, drawbacks, and implications of each. Finally, document all advice and client decisions meticulously, ensuring the client has a clear understanding and has provided informed consent. Question 11. System analysis indicates that a client, facing significant budgetary constraints, has requested a substantial reduction in the fees associated with ongoing risk monitoring services provided by your firm. As a chartered private risk and insurance advisor, CPRIA, you must determine the most appropriate course of action while adhering strictly to the CPRIA regulatory framework and ethical guidelines. Which of the following approaches best reflects professional decision-making in this scenario? Option A. Replace detailed risk monitoring reports with simplified, less frequent summaries to reduce costs, without a comprehensive assessment of the impact on risk exposure. Option B. Propose to eliminate all proactive risk monitoring activities and shift the entire responsibility for risk identification and management to the client. Option C. Immediately implement a blanket reduction across all risk monitoring services to meet the client's budgetary demands, assuming the client will manage any residual risks. Option D. Conduct a thorough review of all risk monitoring processes, prioritizing those essential for regulatory compliance and critical risk mitigation, and propose targeted adjustments only where they do not compromise client protection or regulatory adherence. The correct answer is D. Conduct a thorough review of all risk monitoring processes, prioritizing those essential for regulatory compliance and critical risk mitigation, and propose targeted adjustments only where they do not compromise client protection or regulatory adherence. Explanation. This scenario is professionally challenging because it requires a private risk and insurance advisor to balance the immediate need for cost reduction with the long-term imperative of effective risk management, all within the strict confines of the Chartered Private Risk and Insurance Advisor, CPRIA, regulatory framework. The advisor must demonstrate sound judgment in prioritizing risk monitoring processes that are essential for compliance and client protection, rather than succumbing to short-sighted financial pressures. The correct approach involves a systematic review and prioritization of risk monitoring activities based on their criticality to regulatory compliance and the potential impact of unmitigated risks. This aligns with the CPRIA Ethical Code, which mandates that advisors act in the best interests of their clients and uphold professional standards. Specifically, regulatory frameworks governing insurance advisory services emphasize the importance of robust risk assessment and ongoing monitoring to ensure that clients are adequately protected and that the advisor is fulfilling their fiduciary duties. Cutting essential monitoring processes without a thorough impact assessment would violate these principles by potentially exposing clients to unforeseen risks and jeopardizing the integrity of the advice provided. An incorrect approach would be to unilaterally cut the most expensive risk monitoring processes without considering their regulatory necessity or their impact on risk exposure. This fails to uphold the advisor's duty of care and could lead to breaches of regulatory requirements, such as those mandated by the Financial Conduct Authority, FCA, in the UK, which requires advisors to ensure clients are aware of and manage their risks appropriately. Another incorrect approach is to defer all risk monitoring to the client without establishing clear protocols and oversight, which abdicates the advisor's responsibility and could lead to significant gaps in risk coverage, potentially resulting in regulatory sanctions and reputational damage. A third incorrect approach is to replace comprehensive monitoring with superficial checks, which, while appearing to save costs, does not adequately address the underlying risks and is therefore not a sustainable or ethical solution. Professionals should employ a decision-making framework that begins with understanding the client's risk appetite and regulatory obligations. This should be followed by an assessment of the criticality of each risk monitoring process, considering its contribution to identifying, assessing, and mitigating key risks. Any proposed changes should be evaluated against their potential impact on client protection, regulatory compliance, and the overall effectiveness of the risk management strategy. Open communication with the client regarding any proposed adjustments and their implications is also paramount. Question 12. Comparative studies suggest that event cancellation insurance policies often contain nuanced clauses regarding losses stemming from unforeseen events. A client, planning a large international conference scheduled for 6 months from now, is increasingly concerned about potential disruptions due to a novel, rapidly spreading respiratory virus that has recently emerged. The client seeks advice on whether their existing event cancellation policy, purchased 2 years ago, would provide coverage if the event is canceled due to government-imposed travel restrictions or widespread public health advisories related to this virus. The advisor has access to the policy document, but has not yet conducted a detailed review of its specific wording concerning pandemics or communicable diseases. Which of the following approaches best aligns with the professional and regulatory obligations of a chartered private risk and insurance advisor in this situation? Option A. Advise the client that event cancellation policies typically cover such disruptions and recommend they proceed with planning, assuring them that the insurer will likely cover any losses if the event is canceled due to the virus. Option B. Inform the client that event cancellation insurance is unlikely to cover losses related to a novel virus, as such events are typically excluded, and advise them to self-insure for any potential losses. Option C. Suggest the client purchase a new, separate policy specifically designed for pandemic-related cancellations, without first examining their current policy's applicability. Option D. Immediately conduct a thorough review of the client's specific event cancellation insurance policy, focusing on definitions, exclusions, and conditions related to pandemics, communicable diseases, or government actions, and then schedule a detailed discussion with the client to explain the precise scope of coverage and any potential limitations. The correct answer is A. Advise the client that event cancellation policies typically cover such disruptions and recommend they proceed with planning, assuring them that the insurer will likely cover any losses if the event is canceled due to the virus. Explanation. This scenario presents a professional challenge because it requires a private risk and insurance advisor to navigate the complexities of event cancellation insurance coverage in the context of a rapidly evolving public health crisis. The advisor must balance the client's desire for comprehensive protection with the insurer's policy terms and conditions, while adhering to regulatory requirements and ethical obligations. Careful judgment is required to accurately interpret policy language, assess the likelihood of coverage, and provide sound advice that aligns with the client's risk appetite and the regulatory framework governing insurance advice. The correct approach involves a thorough review of the specific event cancellation insurance policy, paying close attention to definitions, exclusions, and conditions related to communicable diseases or pandemics. The advisor must then engage in a detailed discussion with the client, explaining the scope of coverage, any limitations or exclusions that might apply, and the process for making a claim. This approach is correct because it prioritizes clear communication, accurate policy interpretation, and adherence to the principles of good faith and fair dealing, which are fundamental to regulatory compliance and ethical practice in the insurance industry. Specifically, under the regulatory framework for the Chartered Private Risk and Insurance Advisor, CPRIA, exam, advisors have a duty to act in the best interests of their clients and to provide advice that is suitable and informed. This includes ensuring clients understand the products they are purchasing and the extent of their coverage. An incorrect approach would be to assume coverage based on general industry trends or the client's perception of risk without a detailed examination of the policy wording. This failure to scrutinize the specific policy terms and conditions could lead to misrepresentation of coverage and a breach of the advisor's duty to provide accurate and informed advice. Another incorrect approach would be to advise the client to proceed with the event without clearly outlining the potential coverage gaps related to the pandemic, thereby exposing the client to significant financial risk without their full understanding. This would violate the ethical obligation to ensure clients are aware of all material risks and limitations associated with their insurance policies. A further incorrect approach would be to solely rely on the insurer's initial, potentially broad, statements about coverage without seeking written confirmation or a formal endorsement, which could leave the client unprotected if the insurer later disputes the scope of coverage based on the policy's precise wording. This demonstrates a lack of due diligence and a failure to protect the client's interests. Professionals should adopt a decision-making process that begins with a comprehensive understanding of the client's needs and risk profile. This is followed by a meticulous review of the relevant insurance policy documents, including endorsements and exclusions. The advisor must then communicate the findings clearly and transparently to the client, explaining both the coverage provided and any limitations or potential gaps. This process ensures that the client can make an informed decision about their insurance needs and the associated risks, aligning with regulatory expectations for professional conduct and ethical advisory services. Question 13. The audit findings indicate that a client's charitable giving strategy, while well-intentioned, may not be fully optimized for tax efficiency and compliance. The client has expressed a desire to significantly increase their philanthropic activities over the next 5 years. As a chartered private risk and insurance advisor, CPRIA, what is the most appropriate approach to address these findings and guide the client's future charitable endeavors? Option A. Suggest establishing a new charitable trust solely based on the advisor's familiarity with a particular trust structure, without a thorough assessment of alternative vehicles or the client's specific needs. Option B. Focus on the insurance aspects of philanthropic activities, such as ensuring valuable art donations, and defer detailed tax and compliance discussions until a later date. Option C. Recommend a detailed review of various charitable giving vehicles, such as donor-advised funds, private foundations, and direct contributions, assessing their respective tax implications, administrative requirements, and alignment with the client's long-term philanthropic goals, followed by a tailored strategy proposal. Option D. Advise the client to maximize immediate tax deductions by making large, unrestricted cash donations to a variety of charities, without in-depth consideration of the long-term impact or administrative burden. The correct answer is C. Recommend a detailed review of various charitable giving vehicles, such as donor-advised funds, private foundations, and direct contributions, assessing their respective tax implications, administrative requirements, and alignment with the client's long-term philanthropic goals, followed by a tailored strategy proposal. Explanation. This scenario is professionally challenging because it requires the advisor to balance the client's philanthropic desires with the complex regulatory landscape governing charitable giving, particularly concerning tax implications and disclosure requirements. The advisor must ensure that the client's charitable activities are structured in a way that maximizes their impact while adhering to all applicable laws and ethical standards, avoiding any misrepresentation or non-compliance that could lead to penalties for the client or reputational damage for the advisor. The correct approach involves a comprehensive review of the client's philanthropic goals and a detailed assessment of various giving vehicles, considering their tax efficiency, administrative burden, and alignment with the client's values. This includes understanding the specific rules for deductible contributions, reporting requirements, and the potential for private foundations or donor-advised funds. The advisor must then present a tailored strategy that educates the client on the implications of each option, ensuring informed decision-making. This aligns with the advisor's fiduciary duty to act in the client's best interest and uphold professional standards of competence and diligence. An incorrect approach that focuses solely on the immediate tax deduction without considering the long-term implications or administrative complexities would be professionally unacceptable. This fails to provide holistic advice and could lead to unintended consequences for the client, such as unexpected tax liabilities or difficulties in managing the charitable entity. Another incorrect approach that prioritizes the advisor's convenience or potential for referral fees over the client's specific needs and the most suitable giving strategy would be a clear ethical breach. This demonstrates a conflict of interest and a failure to prioritize the client's objectives. Furthermore, an approach that neglects to inform the client about the reporting obligations associated with their charitable donations, such as the need for substantiation of gifts and annual filings, would be a regulatory failure. This leaves the client vulnerable to penalties and non-compliance. A professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the client's objectives and financial situation. Second, research and analyze all relevant regulatory requirements and available giving vehicles. Third, evaluate the pros and cons of each option in relation to the client's goals. Fourth, present clear, unbiased advice to the client, ensuring they understand all implications. And finally, Assist in implementing the chosen strategy while ensuring ongoing compliance. Question 14. Investigation of a client's request to invest a significant portion of their portfolio in a highly speculative, illiquid alternative investment product, which the client has heard about from a friend and expressed strong interest in, requires the private risk and insurance advisor to consider several approaches. Which approach best aligns with regulatory requirements and professional ethical standards for private risk management? Option A. Proceed with the recommendation of the alternative investment product, but only after ensuring the product offers a higher commission to the advisor, as this compensates for the effort involved in researching less common investments. Option B. Recommend a diversified portfolio of more traditional, liquid investments that are generally considered less risky, overriding the client's specific request due to the speculative nature of the alternative product. Option C. Immediately proceed with the recommendation of the alternative investment product, as the client has explicitly requested it and expressed strong interest. Option D. Conduct a thorough suitability assessment to understand the client's risk tolerance, financial objectives, and knowledge of investments before making any recommendation, and then explain the risks and benefits of the proposed investment in relation to the client's profile. Correct answer is C. Immediately proceed with the recommendation of the alternative investment product, as the client has explicitly requested it and expressed strong interest. Explanation. This scenario is professionally challenging because it requires the advisor to balance the client's immediate desire for a specific investment with the advisor's fiduciary duty to recommend suitable products based on a thorough understanding of the client's risk tolerance, financial objectives, and the inherent risks of the proposed investment. The advisor must navigate potential conflicts of interest and ensure compliance with regulatory requirements designed to protect consumers. The correct approach involves conducting a comprehensive suitability assessment before recommending any product. This means understanding the client's financial situation, investment objectives, risk tolerance, and knowledge of investments. Only after this assessment can the advisor determine if the proposed investment is appropriate. This aligns with the regulatory framework for financial advisors, which mandates that recommendations must be suitable for the client. Ethically, it upholds the principle of acting in the client's best interest. An incorrect approach would be to proceed with the recommendation solely based on the client's stated desire without conducting the necessary due diligence. This fails to meet the regulatory requirement for suitability and breaches the ethical obligation to prioritize the client's welfare. Another incorrect approach is to recommend the product without fully understanding its risks and how they align with the client's profile, potentially exposing the client to undue risk and violating regulatory obligations. Finally, recommending a product that offers higher commissions to the advisor, even if suitable, would be an ethical failure and a potential regulatory breach if the client's best interest is not demonstrably prioritized. Professionals should employ a structured decision-making process that begins with a thorough client discovery phase, followed by a detailed product analysis, and concludes with a suitability determination. This process ensures that all regulatory and ethical obligations are met, and that recommendations are genuinely in the client's best interest. Question 15. Governance review demonstrates that an underwriter has been asked to assess a complex commercial property insurance application where the applicant has provided detailed information on their operations, but has omitted specific details regarding a recent, minor fire incident that occurred on the premises, which the underwriter has discovered through a third-party report. The underwriter is considering how to proceed with pricing and coverage terms. Option A. Increase the premium by a substantial, arbitrary percentage to account for the unknown risk associated with the undisclosed fire, without a clear actuarial basis for the increase. Option B. Immediately reject the application due to the applicant's failure to disclose the fire incident, without further inquiry or consideration of the incident's impact. Option C. Accept the applicant's submitted information at face value and proceed with underwriting based solely on the provided details, assuming the omission was unintentional and not material to the risk. Option D. Conduct a thorough investigation into the fire incident, seeking further details from the applicant and the third-party report, and adjust the premium and terms based on a documented assessment of the residual risk, ensuring all findings and decisions are clearly recorded. The correct answer is D. Conduct a thorough investigation into the fire incident, seeking further details from the applicant and the third-party report, and adjust the premium and terms based on a documented assessment of the residual risk, ensuring all findings and decisions are clearly recorded. Explanation: this scenario presents a professional challenge because it requires the underwriter to balance the insurer's need for accurate risk assessment and premium setting with the client's desire for coverage and the potential for adverse selection. The underwriter must navigate the ethical imperative to avoid misrepresentation and ensure fair treatment of all policyholders, while also adhering to the principles of prudent underwriting. The challenge lies in discerning when a deviation from standard underwriting practices, even if seemingly minor, could lead to significant financial or reputational damage for the insurer or unfairness to the insured. The correct approach involves a thorough and documented review of the applicant's risk profile, considering all available information and applying established underwriting guidelines consistently. This approach is best professional practice because it upholds the fundamental principles of insurance underwriting, which are designed to ensure the solvency of the insurer and the fairness of premiums across the risk pool. Specifically, it aligns with the regulatory expectation that insurers operate prudently and avoid taking on risks they do not fully understand or cannot adequately price. This methodical process minimizes the likelihood of mispricing, adverse selection, and ultimately, claims that could destabilize the insurer's financial position. It also supports the ethical obligation to treat all applicants fairly and transparently. An incorrect approach that involves accepting the applicant's self-reported information without independent verification, despite clear indicators of potential misrepresentation, fails to meet regulatory standards for due diligence. This can lead to the insurer assuming risks based on incomplete or inaccurate data, potentially resulting in underpricing and financial losses. Ethically, it can be seen as a failure to act in the best interests of the insurer and its existing policyholders, who may end up subsidizing the inadequate premiums of misrepresented risks. Another incorrect approach, which is to immediately reject the application based on a single, potentially minor discrepancy without further investigation, can be seen as overly rigid and potentially discriminatory. Thoroughness is crucial. An absolute refusal without exploring the discrepancy or seeking clarification could lead to the insurer missing out on profitable business and could be perceived as unfair to the applicant, especially if the discrepancy is easily explained or rectified. This approach may not align with the regulatory emphasis on fair access to insurance where appropriate. A third incorrect approach, which is to adjust the premium significantly upwards based on a speculative assessment of risk without concrete evidence or a clear rationale, also presents regulatory and ethical issues. This can be viewed as arbitrary pricing, potentially leading to the applicant being priced out of coverage unnecessarily. It also undermines the principle of actuarial soundness, where premiums should reflect a demonstrable and quantifiable risk. Such an approach could also be challenged on grounds of unfair discrimination if the adjustment is not based on objective risk factors. A professional decision-making process for similar situations should involve a structured risk assessment framework. This includes 1. Gathering all relevant information from the applicant and any available external sources. 2. Analyzing the information against established underwriting guidelines and risk appetite. 3. Identifying any discrepancies or areas of concern and seeking clarification or further investigation. 4. Documenting the entire process, including the rationale for any decisions made. 5. Escalating complex or borderline cases to senior underwriters or a dedicated underwriting committee for review. This systematic approach ensures that decisions are informed, consistent, and defensible, thereby meeting both regulatory requirements and ethical obligations. Question 16. The audit findings indicate that the firm's risk assessment process for private clients often relies heavily on anecdotal evidence and subjective expert opinions, with limited systematic evaluation of the potential financial impact of identified risks. This approach has led to inconsistencies in the depth and quality of advice provided. Which of the following best describes the most appropriate and compliant approach for a chartered private risk and insurance advisor to implement to address these audit findings? Option A. Implement a standardized risk assessment framework that combines qualitative techniques, such as risk matrices and scenario planning, with quantitative methods, such as historical data analysis and sensitivity testing, to evaluate both the likelihood and potential impact of identified risks, ensuring the framework is adaptable to individual client circumstances. Option B. Introduce a mandatory client risk questionnaire that captures basic risk exposures, with advisors then using their professional experience to interpret the results and recommend appropriate insurance solutions. Option C. Develop a proprietary quantitative risk modeling software that automatically assigns risk scores based on industry benchmarks and client data, reducing the reliance on individual advisor judgment. Option D. Enhance the training of advisors on advanced qualitative risk assessment techniques, focusing on improving their ability to elicit information and apply expert judgment more consistently across all client engagements. The correct answer is A. Implement a standardized risk assessment framework that combines qualitative techniques, such as risk matrices and scenario planning, with quantitative methods, such as historical data analysis and sensitivity testing, to evaluate both the likelihood and potential impact of identified risks, ensuring the framework is adaptable to individual client circumstances. Explanation: this scenario is professionally challenging because it requires the advisor to balance the need for robust risk assessment with the practical constraints of client resources and the potential for subjective bias. The audit findings highlight a common implementation hurdle, moving from theoretical risk assessment techniques to their effective application in a real-world advisory context. Careful judgment is required to select and apply methods that are both compliant and client-appropriate. Correct approach involves a structured, multifaceted risk assessment that integrates both qualitative and quantitative techniques, tailored to the client's specific circumstances and risk appetite. This aligns with the principles of professional conduct expected of a chartered private risk and insurance advisor, CPRIA, which mandates thoroughness and client centricity. By using a combination of methods, the advisor can achieve a more comprehensive understanding of risk, moving beyond mere identification to a nuanced evaluation of likelihood and impact. This approach is ethically sound as it ensures the client receives advice based on a well-supported analysis, fulfilling the duty of care. Regulatory frameworks for financial advice typically emphasize the need for advice to be suitable and based on adequate investigation, which this integrated approach facilitates. An incorrect approach that relies solely on qualitative methods, such as expert judgment or brainstorming, fails to provide the necessary rigor and objectivity. While useful for initial identification, it can be susceptible to individual biases and may not adequately quantify the potential financial or operational impact of risks, leading to potentially inadequate risk mitigation strategies. This could contravene regulatory expectations for a sufficiently detailed risk assessment. Another incorrect approach that focuses exclusively on quantitative methods without qualitative context can be overly reliant on data that may be incomplete, inaccurate, or not representative of the client's unique situation. This can lead to a false sense of precision and potentially misallocate resources if the underlying assumptions are flawed. It also risks overlooking qualitative factors that significantly influence risk, such as reputational damage or regulatory changes, which are harder to quantify but critically important. A third incorrect approach that prioritizes speed and simplicity over thoroughness, perhaps by using a generic checklist without customization, is also professionally unacceptable. This demonstrates a lack of due diligence and a failure to adapt risk assessment to the client's specific profile, potentially leading to advice that is not fit for purpose. This would likely fall short of regulatory requirements for personalized and comprehensive advice. The professional decision-making process for similar situations should involve 1. Understanding the client's business, objectives, and risk tolerance. 2. Identifying relevant risks through a combination of brainstorming, interviews, and data analysis. 3. Applying appropriate qualitative techniques, e.g., risk matrices, scenario analysis to assess likelihood and impact considering subjective factors. 4. Employing quantitative techniques, e.g., statistical analysis of historical data, financial modeling where appropriate and feasible without complex calculations, to provide a more objective measure of impact. 5. Critically evaluating the results of both qualitative and quantitative assessments, ensuring they are consistent and actionable. 6. Documenting the entire process and the rationale for the chosen methods and conclusions. 7. Communicating the findings clearly to the client, explaining the limitations of the assessment and the basis for recommendations. Question 17. The review process indicates that a high net worth individual client who owns multiple properties, operates a private business, and has significant investment portfolios is seeking advice on comprehensive risk management. The client has expressed concerns about protecting their assets, ensuring financial security for their family in the event of their death or disability, and mitigating potential legal liabilities arising from their business and personal activities. The advisor must recommend a suite of insurance solutions that address these multifaceted risks. Which of the following approaches best addresses the client's comprehensive risk management needs within the regulatory framework for a chartered private risk and insurance advisor? Option A. Advise the client to purchase a high-limit umbrella liability policy to cover all potential financial exposures, as this single policy offers the broadest protection. Option B. Focus primarily on property insurance for the client's real estate holdings and suggest that other risks are likely covered by general business insurance policies. Option C. Recommend a basic life insurance policy and a standard homeowner's insurance policy, assuming these will provide sufficient protection for a high net worth individual. Option D. Recommend a combination of property insurance for real estate, casualty insurance for potential damages, life insurance to cover income replacement and estate planning, health and disability insurance for personal financial protection, and comprehensive liability insurance, including professional liability if applicable to the business. The correct answer is D. Recommend a combination of property insurance for real estate, casualty insurance for potential damages, life insurance to cover income replacement and estate planning, health and disability insurance for personal financial protection, and comprehensive liability insurance, including professional liability if applicable to the business. Explanation: this scenario is professionally challenging because it requires the advisor to navigate the complexities of different insurance types and their suitability for a client's unique circumstances, while adhering strictly to the regulatory framework governing the Chartered Private Risk and Insurance Advisor (CPRIA) designation. The advisor must demonstrate a thorough understanding of property, casualty, life, health, disability, liability, and specialty lines of insurance, and how they apply to a private client's risk profile, without resorting to generic advice or misrepresenting the scope of coverage. Careful judgment is required to ensure the recommendations are not only appropriate, but also compliant with all relevant regulations and ethical standards. The correct approach involves a comprehensive assessment of the client's assets, income, potential liabilities, and specific lifestyle risks to determine the most appropriate insurance solutions. This includes identifying potential gaps in coverage and recommending a combination of property insurance for tangible assets, casualty insurance for potential damages caused by the client, life insurance for financial dependence, health and disability insurance for personal well-being and income protection, and liability insurance to cover legal responsibilities. Specialty lines might be considered if the client has unique assets or exposures, such as fine art or cyber risks. This approach aligns with the ethical duty of care and the regulatory requirement for advisors to act in the best interests of their clients, providing tailored advice based on a thorough understanding of their needs and the insurance products available within the specified regulatory framework. An incorrect approach would be to recommend a broad, one-size-fits-all insurance package without a detailed client assessment. This fails to address the client's specific risk exposures and could lead to underinsurance or overinsurance, violating the duty to provide suitable advice. Another incorrect approach would be to focus solely on one or two types of insurance, such as only property and casualty, neglecting critical areas like life, health, or disability coverage, which are essential for comprehensive risk management for a private individual. This demonstrates a lack of understanding of the interconnectedness of various insurance types and their role in holistic financial planning. Recommending specialty lines without a clear justification based on the client's specific, identified unique risks would also be an incorrect approach, potentially leading to unnecessary expenses for the client and misrepresenting the value of such coverage. Professional decision-making process for similar situations should involve a structured client needs analysis, followed by a detailed review of available insurance products within the relevant regulatory framework. Advisors must maintain up-to-date knowledge of all relevant insurance types and their applications. They should prioritize client education, ensuring the client understands the rationale behind each recommendation and the scope of coverage. Finally, all recommendations must be documented thoroughly, demonstrating compliance with regulatory requirements and ethical obligations. Question 18. The performance metrics show a consistent trend of clients seeking aviation insurance for their private aircraft and helicopters. In reviewing a recent renewal for a client who operates both a light twin-engine aircraft and a piston helicopter, you notice the policy renewal documents do not explicitly confirm endorsements for all pilots who regularly fly these aircraft, nor do they detail specific operational limitations that the client has recently begun to explore, such as occasional commercial charter for non-revenue generating purposes. What is the most appropriate approach to ensure the client's coverage remains robust and compliant? Option A. Focus on securing the lowest possible premium for the renewal, as this is typically the primary concern for private aircraft owners, and address any potential coverage gaps only if a claim arises. Option B. Proceed with the renewal as presented, assuming standard aviation insurance policies are sufficiently broad to cover all pilots and common operational variations for private aircraft and helicopters. Option C. Advise the client that the current policy is likely adequate and that any specific endorsements or operational clarifications are administrative matters that can be handled after the renewal is finalized. Option D. Proactively engage with the client to gather detailed information on all pilots' qualifications and endorsements, and to clarify the exact nature and frequency of the new operational activities. Then liaise with the underwriter to ensure the policy accurately reflects these details and any necessary endorsements or exclusions are in place. The correct answer is D. Proactively engage with the client to gather detailed information on all pilots' qualifications and endorsements, and to clarify the exact nature and frequency of the new operational activities. Then liaise with the underwriter to ensure the policy accurately reflects these details and any necessary endorsements or exclusions are in place. Explanation. This scenario is professionally challenging because it requires an advisor to navigate the complexities of aviation insurance coverage for private aircraft and helicopters, specifically concerning the nuances of pilot endorsement and operational limitations. The advisor must ensure that the client's policy accurately reflects their operational reality, and that they are adequately protected against potential claims arising from pilot qualifications or the specific use of the aircraft. Misinterpreting or misapplying policy terms can lead to significant financial and legal repercussions for the client and potential professional liability for the advisor. The correct approach involves a thorough review of the client's pilot qualifications and the intended operational use of the private aircraft and helicopter against the specific terms and conditions of the aviation insurance policy, particularly clauses related to pilot endorsement and operational exclusions. This ensures that the coverage aligns with the actual risk profile. This approach is justified by the regulatory framework governing insurance advisors, which mandates acting in the client's best interest and providing advice that is suitable and compliant with policy terms. Specifically, under the principles of professional conduct for insurance advisors, there is a duty to ensure that clients understand their coverage and that the policy accurately reflects their circumstances. Failure to do so could be seen as a breach of duty of care and potentially a violation of regulatory requirements concerning disclosure and suitability. An incorrect approach that focuses solely on the hull value of the aircraft without verifying pilot endorsements and operational limitations is professionally unacceptable. This fails to address the fundamental risk factors that influence insurability and claims handling in aviation. The regulatory failure here lies in neglecting the core principles of risk assessment and underwriting, which are critical for accurate policy placement. This approach could lead to a denial of claims if an incident occurs due to an unendorsed pilot or an operation outside policy parameters, leaving the client uninsured for a significant risk. Another incorrect approach that prioritizes securing the lowest premium without a comprehensive review of coverage specifics, including pilot endorsements and operational clauses, is also professionally flawed. This prioritizes cost over adequate protection, which is contrary to the advisor's duty to ensure the client is appropriately covered. The ethical failure is a lack of due diligence and a potential misrepresentation of the policy's true value and limitations. This can result in the client believing they have comprehensive coverage when, in reality, critical risk factors are excluded, leading to potential financial hardship. A third incorrect approach that assumes standard aviation insurance policies automatically cover all operational scenarios for private aircraft and helicopters, regardless of pilot experience or specific flight conditions. demonstrates a dangerous lack of specialized knowledge and due diligence. This assumption ignores the highly specific nature of aviation insurance and the importance of tailoring coverage to individual circumstances. The regulatory and ethical failure is a failure to exercise professional competence and to provide advice based on accurate understanding of the product and its limitations. This can lead to a false sense of security for the client and significant uninsured losses. The professional decision-making process for similar situations should involve a structured risk assessment, a detailed understanding of the client's operational needs and pilot qualifications, a thorough review of policy wordings with a focus on endorsements and exclusions, and clear communication with the client about the scope of coverage and any limitations. This process ensures that advice is compliant, ethical, and in the client's best interest, mitigating potential risks for both the client and the advisor. Question 19. Assessment of the appropriate immediate action for a chartered private risk and insurance advisor, CPRIA, when a client, insured under a kidnap and ransom policy, reports that a family member has been kidnapped and a ransom demand has been made. The policy clearly outlines a specific protocol for incident response involving pre-appointed specialist consultants. Option A. Recommend the client contact local law enforcement immediately to initiate an investigation. Option B. Suggest the client prepare to pay the ransom amount as soon as possible to secure the family member's release. Option C. Advise the client to immediately contact the insurer-appointed specialist K&R response consultants. Option D. Advise the client to attempt direct negotiation with the kidnappers to understand their demands. The correct answer is C. Advise the client to immediately contact the insurer-appointed specialist K&R response consultants. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the advisor to navigate the complexities of a kidnap and ransom (K&R) policy in a real-time crisis, balancing the client's immediate safety and financial concerns with the strict terms and conditions of the insurance contract. The advisor must act as a trusted intermediary, ensuring that all actions taken are compliant with the policy and regulatory guidelines, while also managing the emotional distress of the client. The advisor's judgment is critical in determining the appropriate response, as missteps can have severe consequences for the insured, the insurer, and the advisor's professional standing. Correct approach analysis. The correct approach involves immediately engaging the specialist K&R response consultants as stipulated in the policy. This is the right course of action because K&R policies are highly specialized and require expert handling during an incident. These consultants are experienced in managing such crises, liaising with authorities, negotiating with kidnappers, and advising on ransom payments, all within the framework of the insurance policy. Their involvement ensures that the insured's actions are compliant with the policy's terms and conditions, thereby safeguarding the coverage. Furthermore, regulatory frameworks for insurance advisors, such as those overseen by the Financial Conduct Authority, FCA, in the UK, mandate that advisors act in the best interests of their clients and provide advice that is suitable and compliant with policy terms. Relying on the insurer-appointed specialists directly aligns with these principles by leveraging established expertise to manage the crisis effectively and within the policy's scope. Incorrect approach is analysis. Advising the client to directly negotiate with the kidnappers without involving the K&R response consultants is a significant regulatory and ethical failure. This approach bypasses the expertise required for such sensitive negotiations, potentially leading to actions that invalidate the insurance coverage. It also exposes the client to undue risk and could violate the duty of care owed by the advisor. Suggesting the client contact law enforcement directly before consulting the K&R response team, while seemingly a logical step in some crisis situations, can be problematic under a K&R policy. Many policies have specific protocols for involving authorities, and premature or uncoordinated contact could jeopardize the insurer's ability to manage the situation and potentially void coverage if it contravenes policy stipulations. The advisor's role is to facilitate adherence to the policy's crisis management framework. Recommending the client pay the ransom immediately without expert consultation or adherence to policy procedures is also a critical failure. K&R policies often have specific guidelines regarding ransom payments, including limits, payment methods, and the necessity of insurer approval. Unilateral payment could lead to the insurer denying the claim, leaving the client financially exposed. This approach disregards the contractual obligations and the specialized nature of K&R insurance. Professional reasoning. In situations involving kidnap and ransom insurance claims, the professional decision-making process should prioritize adherence to the specific policy's crisis management protocols. This involves 1. Immediately identifying and activating the designated K&R response consultants as per the policy. 2. Facilitating communication between the client and these consultants. 3. Ensuring all actions taken by the client are in line with the advice provided by the response consultants in the policy's terms. 4. Acting as a conduit for information between the client and the insurer, ensuring transparency and compliance. 5. Maintaining professional detachment while offering support, always grounding advice in the policy's provisions and regulatory requirements. Question 20. Upon reviewing a high-net-worth client's portfolio and estate, a chartered private risk and insurance advisor, CPRIA, identifies significant unrealized capital gains within various investment accounts. The client expresses a strong desire to minimize their current and future tax liabilities on these gains and their overall estate value. The advisor is considering several strategies to address the client's objectives, strictly within the regulatory framework applicable to CPRIA professionals. Which of the following approaches best aligns with the ethical and regulatory obligations of a CPRIA advisor in this context? Option A. Propose a comprehensive plan that includes utilizing tax loss harvesting opportunities, where appropriate, considering tax-efficient investment vehicles such as annuities with tax-deferred growth, and structuring the estate plan to leverage available tax exemptions and reliefs for wealth transfer. Option B. Suggests that the client gift all their assets to family members immediately to avoid future estate taxes, without considering the implications of gift tax, potential loss of control over assets, or the family member's own tax situation. Option C. Advise the client to explore and implement strategies involving the use of complex offshore trusts and shell corporations, without fully disclosing the potential legal and compliance risks, to obscure asset ownership and defer tax indefinitely. Option D. Recommend the immediate sale of all assets with unrealized capital gains to realize losses that can offset other taxable income, even if this incurs significant transaction costs and deviates from the client's long-term investment strategy. The correct answer is D. Recommend the immediate sale of all assets with unrealized capital gains to realize losses that can offset other taxable income, even if this incurs significant transaction costs and deviates from the client's long-term investment strategy. Explanation. This scenario presents a professional challenge because it requires the advisor to balance the client's desire for tax minimization with the fiduciary duty to act in the client's best interest, adhering strictly to the regulatory framework governing the Chartered Private Risk and Insurance Advisor, CPRIA, designation. The advisor must navigate complex tax laws and ethical considerations, ensuring that any recommended strategies are not only tax efficient, but also suitable for the client's overall financial situation and risk tolerance, without engaging in or facilitating tax evasion. The correct approach involves recommending strategies that are legally permissible and ethically sound, focusing on tax deferral and efficient wealth transfer mechanisms available within the relevant jurisdiction. This includes leveraging tax-advantaged investment vehicles and estate planning tools that are explicitly recognized and regulated. The justification for this approach lies in the CPRIA Code of Ethics and Conduct, which mandates that advisors provide advice that is in the client's best interest and complies with all applicable laws and regulations. Specifically, it aligns with the principle of integrity and professional competence, ensuring that recommendations are well-researched, transparent, and legally compliant, thereby avoiding any misrepresentation or facilitation of illicit activities. An incorrect approach would be to suggest or implement strategies that, while potentially reducing immediate tax liability, involve aggressive interpretations of tax law, lack proper documentation, or could be construed as tax evasion. For instance, recommending the use of offshore entities solely for the purpose of concealing assets or income from tax authorities would be a significant ethical and regulatory failure. This violates the duty of honesty and transparency and could lead to severe penalties for both the client and the advisor, including professional sanctions, fines, and legal prosecution. Another incorrect approach would be to advise on strategies that are not supported by current tax legislation or established case law, as this demonstrates a lack of professional competence and a failure to uphold the duty of care. Such advice could expose the client to unexpected tax liabilities and penalties, undermining the advisor's credibility and professional standing. Professionals should employ a decision-making framework that prioritizes understanding the client's complete financial picture, including their goals, risk tolerance, and existing assets. This should be followed by thorough research into all legally available tax planning strategies within the specified jurisdiction. Any proposed strategy must be evaluated for its compliance with tax laws, its ethical implications, and its suitability for the client's circumstances. Transparency with the client regarding the risks, benefits, and legal standing of each strategy is paramount. If there is any doubt about the legality or ethicality of a strategy, the advisor should seek clarification from qualified tax professionals or regulatory bodies, or decline to implement the strategy.